usually it takes 1 to 2 pay cycles to change your contribution. So just make sure you're looking at that and what it is, and that you're maxing out, if you can, paying yourself first. That's a way to grow wealth. A good rule of thumb is to save at least 10% of your income generally.
Welcome to a Wiser Retirement Podcast. Are you curious about how to optimize your tax plan for 2025? I'm Casey Smith. Today I'm joined by Shauna Theriault, Wiser's most decorated advisor. She's a CPA, she's a CFP, she's a CDFA.
Right.
And she's a part of the 8:30 p.m. workout crowd, and she'll beat you up if you need it.
I don't know about that. I'm not violent.
No, that's true. You're not very violent. She's a teddy bear, but just a very determined person. We've already done the math before this podcast. I've worked out 35% of this year.
I've worked out 100% of this year.
Shauna's worked out 100%. There's no chance of me catching her unless we can get her off her game somehow. Anyway, each week we bring you practical advice on retirement investing and planning for your financial future. Shauna, let's get started.
Sure. So today we're going to be talking about taxes and planning for 2025, which is could be boring, but there's things to think about at the beginning of the year and things you need to consider.
We did a pilot video recently focused around Roth versus traditional savings. Mm-hmm. And I'm getting lots of feedback from people on that. Did
they say I talk too fast?
There's just so much information. You got to get it out. No, there was no critique on our delivery. Yeah. I assume our delivery is pretty good, but people are questioning our advice.
Oh,
and it's very interesting. I think we should bring them on the show, these people, and we should have a match. Pilot CPA tax knowledge versus the real CPA tax knowledge. I don't know. I mean, I know who would win. But I just chuckle. So there's a ton of views, but there's not direct commentary necessarily. I think there may be 2 comments. The comments are happening inside the Facebook page where someone had posted the link, and I've been getting little snapshots of the different comments, and they're all wrong, and all have tons of assumptions that are not law as of today anyway.
Right.
But
that's I think
we might have to do this year like a 2.0 on that, and then take all the comments and give like a rebuttal.
Okay.
So maybe that's coming in the next month or so. I'll have to work that into our show docket here. But I'm not angry about it at all. I just kind of smirk and think, it's amazing how smart some people think that they are, but they're missing out on these things. And all the guys that are in the market-based cash balance plan that are actually, they're being bullied for going into the plan. They're being called idiots and worse stuff. Yeah. It's horrible. God. It's horrible. I don't know. I want my pilot to feel confident, quite honestly.
Yeah.
But sometimes that confidence bleeds into other things that they're not actually trained in. That kind of makes me chuckle.
Yeah.
But I don't know. Sometimes the loudest people are also the minorities, and based on helping over 500 pilot families here just in the last year alone, I would think that that most of them don't really think that way. It's just a few squeaky wheels, right?
Right. Exactly.
But anyway, let's, when is the right time to be thinking about tax strategy? If you're tuning into this episode because you're concerned about your 2024 tax return, you need to tune back out because there's nothing you can do now for 2024 unless you're a business owner. There's a few small things you could do there.
Right.
But as a W-2 employee, there's not much else really you can do at this point. So
the only thing you can do after the fact is maybe some retirement contributions, but they're most likely not going to be deductible. And
correct.
But still.
Correct. So now maybe you've had a crazy 2024 and you're thinking, I need to get on top of this tax stuff. Now you probably want to tune back in and let's talk about some tax strategies for 2025 at the front of the year, as opposed to doing it after the fact, right?
Right. And not everything can be planned in the beginning of the year, obviously, because it depends on things changing throughout the year with your income, if you have portfolio income, different things happening. So,
and just to be clear, we're talking to everybody now. This is not a pilot episode like we do maybe once a month or so, but this is just a regular episode talking to everybody who's out there. We're talking to you. So let's talk about first maximizing retirement contributions. Give me a walk down on, oh my gosh, Shauna, I forgot. Hadley put it right here in front of me and I missed it. I'm supposed to ask you guys to subscribe to our podcast anywhere you're listening to. So if you're listening on Apple or Spotify, wherever you're listening, make sure you subscribe to the podcast. It helps us in our rankings and also alerts you when we post new episodes. Don't forget to do that. Sorry about that, Hadley. We got us back on track here. All right. Maximizing retirement contributions. Let's start there.
Yeah, sure. So, I mean, just thinking about, I would look back to what you did last year and just think about, what changed this year. Think about, should I do pre-tax or Roth? There are some situations potentially to do Roth if you're in a low tax bracket. Think about that. Make sure a lot of bonuses happen or seem to happen in the beginning of the year. So think about how you're going to maximize your retirement contributions efficiently. If you're in a higher income bracket, you get to a point where your income is so high that they stop contributing. And so be thinking about that. But, if you're still the steady Eddie saver, the 4 and 5%, first of all, make sure that you're getting enough to get your employer match, and contributing enough for that, but try bumping it up too. So bump it up each year. If you're not maxing out, pay yourself first. That's very important, since we are talking to everyone. So consider bumping it up and, making do with a little bit less in the paycheck potentially because you're paying yourself for the future. So understanding that, but also the catch-up rules changed a little bit this year. There's this weird, funky rule that they threw in this year. So catch-up, if you're over 50, is $7,500. So for ages between 60 and 63, it's $11,250.
So weird, isn't it?
I know. The industry is so, what are we doing with that?
What about the 64 and 65-year-olds that haven't saved anything?
I know. Yeah. It's really odd. So
if you're
it's a 4-year window.
60 and 63, you can put in an additional $11,250 in 2020.
Yeah. So it's really like what, $4,000 more than you can do at 50?
That's not on top of the $7,500.
No.
That's just
right
in addition to the standard contribution, which would be $23,500.
$23,500 this year is the standard deferral max. For W-2 employees, and then the catch up is $7,500. Unless you're in that that age bracket, which is completely strange. I don't know where they got that, but
I bet you that if we looked at Congress, I wonder if most of Congress is between the ages of 60 and 63.
Maybe. I was trying to think did the people during COVID 4 years ago, how old would they have been? I was trying to figure out what was the thinking, but I'm sure it's really confusing and annoying for HR and ADP payroll processing companies trying to figure that out. But so just make sure you're maximizing where you can there, and just looking at that. There's something that came up and thinking about, we've had this question a lot talking about Ross, but also looking at, the beginning of the year where Secure Act 2.0 allowed workers to have the option to have the employer match treated as a Roth contribution. So, and I know a lot of people are interested in that. What they didn't know is that the company's getting a deduction for that. So it's being taxed to somebody. So it's actually being taxed to you.
Right.
So it's not like they're just going to put it in Roth for you and you get it tax free in the future. That becomes taxable income to you. So consider that. You have to take into consideration all of those things but it's like looking at the landscape of, making sure that you're changing, some people change their percentages at the end of the year before, either they maxed out and it stopped or they changed it at the end of the year. So make sure that usually it takes 1 to 2 pay cycles to change your contribution. So just make sure you're looking at that and what it is, and that you're maxing out, if you can, paying yourself first. That's a way to grow wealth. A good rule of thumb is to save at least 10% of your income generally. But if you can max out, this
is the optimizing your tax plan episode. So people really tuning in here probably don't have any debt necessarily they were trying to eliminate. We're just trying to save money on taxes.
Right.
I would say pay more tax, eliminate debt first.
Yeah.
But But the tax strategy here typically is to get everything in pre-tax because you're in a higher tax bracket. If you're in the mid-level tax brackets, then maybe you split up 50 pre-tax, 50 Roth. And remember, we're talking to thousands of people. We have thousands of downloads on these podcasts. So if you're already a client of Wiser and we've already given you a recommendation, don't call us up and say, "Hey, you said on the podcast." We're talking to a lot of people.
Right. We're looking at your specific situation individually.
If you've asked us directly, then yes, keep with that. And then obviously we review that during our tax planning strategies in our review meetings.
Absolutely. So just looking at that, the other thing, making sure you're maximizing retirement contributions. The other way to save tax is if you're in a high deductible healthcare plan is doing the HSAs, health savings account, and maxing those out.
Man, that's a free.
Yeah. You
get it tax-free on the front end and you get it tax-free
on the back end.
On the back when you pull it out. I think that's the only thing that's like that.
Right.
And $4,300 for an individual, $8,550 for a family. And typically what we tell our higher wage earners is you don't spend it. You just keep saving it and you can invest it. Now it's going to grow tax-free. And then when you get to retirement, you get to do what?
Pull from it.
Yeah.
To pay for your expenses.
Pay for your healthcare
Especially
expenses.
in that nice window, between retirement and RMD and, then maybe that's when you want to look at Roth conversions then. And so then you can pull money from an HSA for free to pay for those premiums if you're before Medicare age.
And this is, again, planning that takes place well before your retirement to actually build something that's significant enough to do that.
Yeah.
Which is why planning is so important.
Exactly. Looking at your, check withholding, some people adjust their withholdings each year. You don't want any surprises. So, just making sure starting out the year, if you had made changes to anything as far as your withholding, you'll have more clarity probably in April when you run taxes to see, did I owe taxes? Or if you're doing tax projections throughout the year, you'll kind of know where you are, hopefully.
Right.
But just adjusting your withholding and thinking about that, especially if you're going to be making less or more this year, maybe you're getting close to retirement and your income's going to go down, or maybe it's going to go up this year. So just making sure that you're paying attention to your withholding going forward.
Or starting to pay estimated payments, especially for business owners.
Absolutely.
It's important.
Absolutely.
Stay on top of that.
And if you're starting to create those opportunistic funds, where we're doing brokerage accounts, et cetera, you may have capital gains, interest, dividends. You may not be able to do enough withholding. You may have to make estimated payments in those regards too. So, another thing to consider is, considering Roth conversions. I'm not a huge fan of converting at the beginning of the year just because, sometimes you don't know what the taxes are going to hold later in the year on your portfolio potentially, or there's other opportunities that come up, but just thinking about, do I need to do that? Looking at your required minimum distributions from either IRA, if you're required minimum distribution age, or inherited IRAs. So, non-spouse beneficiaries, you have that 10-year window where you have to take money out and, distribute it by the end of 10 years. And so with Roths, you don't have to take anything out generally until the 10th year. That's kind of what I usually say is wait till the 10th year. It's not taxable, let it grow tax-free. But with the pre-tax and traditional IRAs, looking at what is my income going to be this year? Should I take a portion out? You may have to take some out anyway, just depending on other things like when they passed, if they were taking it, et cetera. But just be on the lookout for thinking about that. Especially,
so those values are determined on the 12/31 value of the year prior. So by January 2nd, you now know what the RMD is going to be for that particular year. You can use that in your tax planning. You have to pull it out.
Great point.
And typically by September, we kind of know what the income's going to look like for the year. And so that's when you start taking your RMDs and making other money moves for taxes, obviously.
Right. So if you can find a way to save tax and then have to take those, it's just and sometimes you can't. Sometimes you just have to take it, and maybe your income's not going to change over the 10-year period, and you just have to take it maybe equally over 10 years, just to spread it out. Maybe it doesn't matter, but just taking all that into consideration, but just be aware of it. I especially, thinking about that too, I'm always thinking ahead. Is my income going to change in the next few years? So be thinking about that too, instead of, potentially bundling up all the income 1 year, and maybe your income's going to go down the next couple of years because you're getting closer to retirement, or I don't know, there's a job change or something's happening. Sometimes we don't know about it, but sometimes we do in advance. And so just taking all those things into consideration.
Yeah.
Just know what you kind of know my pay is going to be this, my RMD required minimum distribution is going to be this. This is kind of what my, portfolio income was for last year. We don't know potentially what it's going to be because of capital gains sometimes, just taking all those things into consideration. Just know where you stand for the year, adjusting your withholding accordingly, potentially, how much should I defer to my 401k? Can I put more in there? All of those things,
Yep.
The standard deduction, most Americans now have the standard deduction. I know we talk about that. It's so much higher now. It's $30,000 for married filing jointly and $15,000 for single this year. There's other considerations, like if you're above 65, et cetera, but it's generally $30,000. And so what that means is if you don't have deductions greater than $30,000, then you just get the standard, and there's no reason to track expenses necessarily through the year.
Right.
Sometimes we don't know what that is. And so there's a couple of rules that are, so you may want to track your expenses just in case, but there's a couple of rules that are changing. So we have this, this TCJA that expires at the end of 25. It sunsets, and it affects a few things. As far as deductions are concerned, it limited our state and local taxes to $10,000, which is like your real estate taxes, your state taxes, et cetera, that you can deduct on your tax return. It limited it to $10,000. We don't know what they're going to do in Congress. We don't know what they're going to change.
You still get that for 25, or that expired in 24?
You get that in 25.
Okay.
So, it's capped in 25 still.
Yeah. Okay.
It was a cap. Most people used to have a higher deduction than that.
Yeah.
So it was kind of a bad deal for, but they made the standard so high, they tried to make up for it, if you will.
Sure.
So that's where the 30,000 now comes into play. But, so you're capped at 10,000, for that piece, and that sunsets and expires in 2020 at the end of 2025.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
The other thing with that, and just understanding the legislative changes, so taxes change every year, but the TCJA came into place in 2018 and it was through 2025. So there's a few things that affect that. So it's, the state and local taxes, and there's a lot more, but it's just a couple high level. It's the estate tax exemption also is going to be changing at the end of this year. So for someone in a really, large estate, they may want to consider looking at gifting and talking to an estate planning attorney about that, et cetera. So that's going to be changing. Most Americans won't be affected by it because most of us don't have $14 million each in assets, or even $7 million each in assets, which is what it's going to go back down to in 2026 if they don't do anything.
Okay.
But the other thing that it changes is the tax brackets. So they adjusted the mid-tier tax brackets. So I personally think they're going to change it and maybe make it permanent or what have you, because if they don't do anything, the mid-tier tax brackets are going to jump back up from 22 to 24, for example. It will slightly go up, but it's going to affect so many people.
I think this is interesting. So we get feedback from clients, every day in our review meetings, and it's some people. I guess I should say it like this. There's a lot of people that assume that it's actually going to change back. And I think that's a wrong assumption. I think with how the election went, we could assume that it's going to at least stay the same, if not possibly go lower in some categories. So I feel more optimistic about this, where prior to the election, I was like, oh, wow, this is going to be a huge burden for a lot of people. Yeah. At least at clients of a wealth management firm, right?
Yeah.
Is that how you feel about it as well?
I do.
That we feel like that this probably... It'd all be legislated out by December. At least
for 2 years. Yeah. I mean, I at least for 2 years, depending on, what happens in 2 years in the midterm elections.
Yeah.
And then maybe it's just nothing at that point.
They could make it go for 4 years right now.
Yeah. Yeah.
When after January 20th, I guess, but
I don't know. I feel like if they raise taxes, they're cutting interest rates right now, right? And so if they raise taxes, it's kind of converse to what they're trying to do. They're trying to pause inflation. I don't see them letting it sunset.
I don't see taxes going up.
No,
I see,
which is what would happen if they didn't adjust those brackets.
The rhetoric that we're seeing is excessive spending is going to be cut. So you essentially could do the same thing, have lower taxes and lower spending, and that might get a balanced budget, but no one's ever said the words balanced budget ever in this administration that's coming in, or the one that's going out. I don't even know if my lifetime I've heard that word. No, like 40 something. Was it like 20 some years ago? Maybe when I was little. George W. Bush had a balanced budget, I believe, and possibly Clinton. Our listeners probably know more than I do about that era. But
I didn't mean to throw you on the spot because I literally don't know. I'm like,
Newt Gingrich, right? Didn't he have a balanced budget? Somebody can tell me.
I feel like my whole career we haven't had one. I've been in the industry for like 27 years, and it's it's just the norm, right?
Fought a bunch of wars and it all just went crazy. Right. But yes.
Right.
But yeah, I think from a tax standpoint that you paying more tax, that whole rhetoric is probably politically motivated and it's not really factual at this point. Yeah. It's a fair statement.
Yeah. But they do have to do something or it's going to sunset at the end of this year. So they either have to like make it permanent or extend it or kick the can like they do or,
I think they make it either permanent or they extend it for another 4 years. That's how I see it.
Yeah, probably. Most likely.
There's probably a lot of nastiness around it. But again, if you're listening to a wealth management podcast, you probably are a beneficiary of any changes that are happening.
Yeah. Yeah. The beginning of the year for charity, I like to just think about this because some aren't aware, and I know we've talked about it before, but some aren't aware that you can give either part of your required minimum distribution to charity or appreciated securities directly to charity. And some will realize it throughout the year and go, oh, well, I've already been contributing monthly. So this is the time, if you have appreciated securities in your taxable account, you could gift those to your church or what have you, whatever charity you have, versus doing, monthly cash distributions. And so the beginning of the year is a great time to say, okay, if you are charitably inclined and you gifted last year and you're doing cash, maybe consider those other two options and then stop the cash contributions and think about how you're going to give to charity this year, because sometimes you get halfway through the year and you're like, well, I've already done half of it. And, I'll just look at it in January.
So if you're 70 and a half or older, you could be gifting out of your IRA.
Right. It has to go directly from the IRA to that.
Correct.
Yeah.
Also, if you want to do a donor advised fund versus giving yourself, you could put that into play. I think that's probably the two big things, right? Why you would change.
Yes. And or just doing a donor advised fund or gifting appreciated securiries from your brokerage. Now, I mean, the market was up huge the last few years. So, I mean, especially last year. And so this is a time to say, okay, in thinking about, I kind of put on here the allocation considerations. It's like, okay, am I getting closer to retirement? Since the market's been up so high, should I trim some back and take some off the table? And if I'm going to do that in a brokerage account, just to be a little, maybe because you're getting closer to retirement. So be thinking about that. It's a good time to take a little bit off if you want to get a little more conservative and start, if you're retiring in a couple of years, for example, maybe you take some profits off the table. But if you're going to, gift to charity, maybe before you sell those profits in your brokerage account. This doesn't work for a retirement account because it's even if it's appreciated, you're not being taxed on it. Right. So then you can think about, well, maybe I'll gift a portion of this stock to my church whenever you want to during the year. It doesn't have to be right now. and just not sell that portion and gift it to them. And, while you're thinking about the allocation and things like that.
I would also add that this is the great time to start direct indexing. So if you have, I'd say over $500,000 inside a brokerage account, so non-IRA, non-retirement money, there's a good chance that you should be doing direct indexing versus just buying ETFs directly.
Right.
It's such a powerful investment, but it takes, because of all the gains that are in the portfolios, it takes a little time to work those back out through the tax loss harvesting mechanism through direct indexing. So you would want to start that at the beginning of the year. So you now have a full 12 months to be able to hopefully work those gains off into losses, and you have a tax credit instead of taxable gains at the end of the year.
Yeah.
So that now is a great time to be considering that in brokerage accounts. And for the most part, I think we've gotten through all the clients who've come in for review meetings in the last year have transitioned to those direct indexing accounts.
Absolutely.
I'm amazed. I spend time with other advisors, and I'm always amazed how people don't do direct indexing. And I think it's because maybe it's hard.
It is hard.
And it's more labor, and people want easy.
Right.
Even advisors. But we have a process that makes it pretty straightforward here at Wiser. And man, when you see the tax benefits that we're able to provide, it's amazing.
It is huge, especially when you're talking about, those brokerage accounts and then wanting to trim stuff back. It just helps in the future to create those credits. And if you have a market downturn, that's when we don't want to have a market downturn. It's inevitable. It's going to happen, but those are the times you can take the opportunity to take some losses,
or even just volatility. If you have extreme volatility, you can also do that as well.
Absolutely.
Monitor your adjusted gross income. What do you mean by that?
Well, it's just, there's sometimes you can't help it. There's certain credits or, tax advantages you may have for having lower income. And so just understanding where your adjusted gross income is, taking into consideration any bonuses, your W-2 income, self-employment income, managing it that way, but also the IRA, RMDs, like we talked about, and just other portfolio income. So just understanding where, your adjusted gross income is, because what your earnings do and your other income impacts potentially tax benefits that you have. Now, I'm not a proponent of reducing income just to save taxes, meaning like I would still rather earn 200,000 and pay tax on it versus like I'm just going to try to earn 50 so I have less taxes. I mean,
I always chuckle when people say this statement. I didn't take on that project, or I didn't do that because all the money just goes to the government. There is no tax bracket that's even possible.
Yeah.
So it's like, even if you're in the highest tax bracket, you still going to keep 42 cents is going to go out. So let's just keep it simple. You're going to keep 60 cents on the dollar, basically.
Yeah.
It's like, so would you rather have 60 cents or no cents?
Right.
And most people go, I'd rather have the 60 cents.
Or no cents. It sounds like no cents
instead
of 0
no
cents.
Yeah, you might, it's a different statement when you go, I have enough. I'm just tired of working.
Right. That's a lifestyle decision.
That's a lifestyle decision.
Sure.
But when you hear people, and most people who say it, again, that's why I chuckle. Most people I hear it say it, they're like in the 20% tax bracket. You're like in the standard American tax bracket. Like, what do you mean the government's going to take it all? It just means you're not planning properly.
Yeah.
And a lot of times I feel like it's said by people who work for themselves. And so they're not doing tax planning, and they get to the end of the year and it's a surprise what kind of tax bill they get. Yeah. And that's why they feel that way. That's all going to go to the government. Well, yeah, because you didn't do quarterly payments. You didn't do the planning, but.
Well, I don't know. I feel that though, because, raising kids and, being in the throes, and we see it all the time where it's like, individuals come into us and they're trying to build their wealth now. And I mean, wealth, like being retirable. I don't mean like, Trump. Well, that's not what I was, it's like building wealth, meaning being retirable and being able to be comfortable. And, when you're raising kids and doing that and, working and you're trying to buy a house, just all the things that come with it, it feels really hard in the messy middle.
Yeah.
Like, is it ever going to be there? Right. And so when you have a tax bill on top of that, it's like, I don't feel like I'm rich making this much money. I have kids, I'm buying a house, I'm running my household, and everything costs so much. Like, I feel that Americans feel squeezed,
Oh no, there's no doubt about that.
But our tax rates are not that high.
But if you did planning, then you would know that what was coming up. That's
Exactly. Completely.
This is my favorite section. Entrepreneurs, small business owners, optimize business deductions. That's so important. That you really don't wait till the end of the year, but you can launch out 401k plans, you have profit sharing plans. If you're a small business owner working for yourself, I love the solo 401k plan.
Mm-hmm.
You can pack away like over 60 grand in there if you're doing well.
Mm-hmm.
If you got $250,000 in profits or so, you can put away a lot of money. All kinds of opportunities that you can do as a business owner.
Yeah, absolutely.
Tell me about the QBI deduction.
So that is it was a deduction that allows them to deduct up to 20% of their qualified business income. This is part of, it was to help, they set that in 2018. Again, that's part of the deduction that was, set to expire at the end of this year. I think that will be extended too, potentially. I think they're going to extend the whole thing. So it was just help to reduce taxes for business owners, and reduce the corporate tax rate. So it's the section 19,
that's supposed 199A. To expire this year
yes,
as well.
That is part of that whole bill, the TCJA Act.
Yeah, I see that sticking around too.
Yeah, I do too. So especially if they feel like business owners are getting squeezed and, I think I agree with you that they may just extend it for 4 years or just make it permanent, but it is subject to change. So it's just good to think about that now if you want to take advantage of it, since it could expire at the end of the year.
These are all things that a financial advisor needs to think about when they're working with their clients. Shauna and Missy do a great job of this. I don't know, as our fearless leader here, I have to think why is Wiser different? And honestly, robots can invest in these ETF portfolios today. You don't have to have a financial advisor to find a company that can just deploy a portfolio for you.
But that's such a small piece of the pie.
It is. But advisors have to understand tax. And so many advisors today simply say, oh, you have to consult with your tax person, or they don't even do tax loss harvesting. Mm-hmm. Some of the biggest firms in the country, household names, those advisors don't do tax loss harvesting. Mm-hmm. And so it's such an important component that our advisors here fully understand tax and work that into the overall planning strategy. Yeah. It's a value add that's not seen in the portfolio directly, but it's there. The rate of return is higher because you have a more competent tax strategy. It's about how many dollars are you keeping on the other end.
And it's about
term, right?
and it's about understanding the recommendations you're making. Years ago, I saw that, and I didn't understand tax. And you don't have to be a CPA to understand the tax ramifications of what you're doing. But that's exactly why I got the CPA, so that I would understand when making recommendations, because it affects so many other things.
Absolutely. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the episode notes below. Thanks again for listening. We'll see you guys next week.